So at the heart of the one already loan product is that we look at some taxi drivers out there, taxi operators. You're working for somebody, you're paying somebody $25,000 a week to drive for them. So we say, come to Dollar, we'll make your loan payment $25,000 a week, and you own your car in 2 years.
About winning the taxi?
I feel very good. I'm not telling no lie. I feel very, 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 very good. But my family will take care of as well. You understand? So it means a lot to me.
Me no know about you, but me know say yeah. Dollar lend money, yeah. Dollar better than the EM. One and ready, yeah. Oh, yeah. That better than the EM. My taxi, yeah. Oh, it better than the EM. No get no problem. Dollar better than the EM.
What an exciting recap. So it is my absolute pleasure to be here this morning as your moderator. My name is Renee McDonald. I am CEO and Investor Relations Lead at Learn Grow Invest. And today I'm here with the team from Dolla Financial Services, and they are here to host their Q1 2025 earnings call and share with you, their shareholders, just how they have performed, what has changed since the previous quarter, and what they're looking forward to for the rest of the year. As we prepare to welcome the team, let us just start off with a word of prayer. Heavenly Father, we give you all glory, honor, and praise. We thank you, mighty God, for this day, for this opportunity to meet in this way. And we just ask, Lord, for your covering over the technology, your covering over the team as they present, Lord God. I pray that your presence will be in the midst and that you will be glorified and honored in all that is done and said here today. In Jesus' name, amen. All right, so with me, I have CEO Kenroy Kerr, CFO Trevine McKenzie, and CEO of Ultra, David Henriquez. But right now, we're gonna ask Kenroy to join me on stage. So welcome, Kenroy.
Hi, Renee. Good morning. Thanks for having us as always.
It is always a pleasure. I will hand right over to you so you can get into your presentation.
All right. Thank you very much, and good morning to everyone who has taken time out to join us today. And I just want to, again, Renee, say thanks for this platform where we can share our quarterly result. Of course, I know this is something that our shareholders look forward to, and we're always here to provide that information in a transparent way. I've always said whether it's good or bad, we'll always be here to respond to the questions and provide the information that we think would be very valuable to your shareholders. So I'm Kenroy Kerr, CEO of Dolla Financial Services, and I'm pleased to provide you with an update on our financial performance, our strategic progress, and just the outlook for the remainder of the year for Dolla Financial Services. We started 2024 with a solid momentum, I'd say, especially when it comes to revenue and when it comes to the loan portfolio growth. While we're still focused on maintaining that loan quality, operational efficiency, and of course some strategic growth to go along with that. Today, I'll just walk you through some of the key indicators, some sector performance, some of the initiatives that we undertook in Q1, and just some of the initiatives that will be driving us forward. I'm joined by Trevine McKenzie, our CFO, who will provide some insight into the numbers that we released for Q1, and David Henriquez, our CEO for Ultra, who will just give you some update on how that segment performed for Q1. All right, so here's just a quick overview of our Q1 performance. So we ended the quarter with a strong loan portfolio of 4.3 billion, and this reflected good organic growth. Every single dollar of loan that was added to the portfolio is really a testament to the hard work of the sales team that we have, who goes above and beyond in terms of finding the business and and us booking those as quality loans. Year over year, would have seen a 52% increase in the loan portfolio, and this again is driven primarily by new loan disbursement. This was, of course, made possible to the bond raise that we did in Q4 of 2024. That's last year. Our revenues for Q1 ended at 502 million, and this represented a 38% increase year over year when we compare Q1 2024 to Q1 2025. That's a 38% increase year over year. Our PBT, or profit before tax, ended at $121 million for the quarter, while this represented a roughly 10% growth over the prior quarter, which is Q4 of 2024. We would have seen a 21% decline year over year. And of course, this was driven primarily by the provisioning or the write-off of a debt that we thought or we deemed unlikely to recover. Our efficiency ratio of 56%, that's where we ended, 56%. It really shows some prudent cost management despite some of the rising inflationary pressures that we have been seeing, along with the write-off I spoke about just now. In terms of our activities, in terms of corporate social responsibility, we undertook several initiatives during Q1, so I'm just gonna quickly highlight a few of these initiatives. Our CSR activity, I'd say, is an extension of our brand, and it's all about empowering people, especially those that are underserved. So we supported students from Excelsior Community College through sponsorships to attend the Jamaica Stock Exchange Regional Investment Conference. We through Mayberry Swim Classic, we demonstrated our commitment and continued investment in youth and their fitness and discipline. Our One and Ready loan campaign that we launched last year, June, culminated in the handing over of a 2018 Toyota Probox to a well-deserving customer. I think that campaign was really exciting and influenced a lot of the growth in the loan portfolio that we saw in the latter part of 2024 and indeed early 2025. And of course, our International Women's Day. On International Women's Day, we would have recognized the women that are powering Dolla Financial and Ultra Financier through tributes and a lot of storytelling. So those are just some of the key CSR initiatives that we undertook in Q1 of 2025. So this chart that is being displayed on the screen indicates the loan portfolio by sector. I believe it shows just how diversified the portfolio is. We mentioned as at Q1, we maintained a strong base when it comes to business and entrepreneur loans. That accounted for about 90% of the overall loan portfolio. You can see here that transportation and real estate and construction really remain some of our top performing sectors. And of course, we continue to closely monitor the concentration risk to ensure that the portfolio remain well diversified and can withstand any unforeseen events that may happen in any particular sector. These are some of the key performance indicators that we look at and we share with the public with every at the end of every quarter when we post our results. So the credit quality really remains stable, while the NPL ratio was at 11.5% as at the end of Q1. And to some extent, it is above our internal threshold because we primarily seek to keep the NPL at sub 10%. This increase, all being a minor increase. We note that this is primarily driven by a few loans that we have that we're in the process of liquidating the assets. So we anticipate that we'll be seeing some reduction in this going forward, well, or as soon as we are able to liquidate those assets. Our collections team, they are rather aggressive in maintaining the delinquency, and we expect, while we do expect fluctuation sometimes, again, that's really due to the time that it takes to dispose of certain collateral that we have on the portfolio. The ECL remains well contained at 3.1%, and again, our portfolio is 86% secured, which of course means that our risk is appropriately mitigated, I would say. Despite the write-offs, despite the write-off of a bad debt, as we indicated earlier, our efficiency ratio was at 56%, which shows some strong cost control. We're quite optimistic that this will return to sub 50, which we've had it for a number of quarters, and we have begun to tighten up some of our non-core expenses and just explore other ways that we can scale as we grow, whether it's looking at automation and just different ways to enhance the turnaround times for the transactions that we do. All right, so while automation, we've started to look at things, we've started to look at some aspect of the company and how we can automate going forward. And I know that this will not happen overnight. It's not something that is practical in the very, very short term. We really have begun to focus on that kind of transformation, especially when it comes to the middleware to connect the origination, the adjudication, and the disbursement of our loan. And we'll be looking at that going forward to ensure that we can, again, see some amount of scaling as we grow. At this point, I'm just going to pause here because I know you have a lot of questions when we complete this presentation. So I'm just going to pause here and allow David Henriquez, CEO for Ultra, to give you some insight in his segment of the business.
Thanks, Kenroy. And again, morning to all our shareholders, everyone watching. And thank you again to the Learn, Grow, Invest team for having us for another earnings call for another quarter. So I'll just be pretty quick. Ultra our loan book is now sitting at about 1.66 billion at the end of March 2025. Not ideally where we want it to be, but not upset with where we are. We've definitely been focusing on the quality of our loans more than just, trying to hit monetary targets. Our average loan size is now sitting at about $17.5 million. Obviously, we do have a couple smaller loans, a couple larger ones, but this is a very comfortable average for us and kind of where we want to be as we look to diversify our portfolio and diversify the type of loans that we are giving. As you know, Ultra always focuses on having secured loans. So we are holding about $3.6 billion in collateral. And this stretches across the usual suspects: property, both residential and commercial properties, real estate, both urban and rural, motor vehicles, commercial equipment, and some blue chip stock. So as we look to ensure that our portfolio remains as close to 100% secured as possible, we are also looking to diversify our portfolio and ensure that the collateral that we hold is fairly diverse, just to protect us. So as Kenroy had mentioned, our NPL has slid as a group above 11, and that is largely attributable to Ultra and our portfolio. But we are not worried. The fact that we have the majority of our portfolio secured, we are in the process of liquidating a number of properties. And as we know, in Jamaica, it does take quite a while to liquidate property. So we are not worried. We are closely monitoring it as we go forward. And we do see that within the next 3 to 6 months that we will have our NPL back below 5% as we always intend for it to be. So as we look forward, our aim is to get our loan book to over 2 billion within the coming quarter. And as I mentioned, maintaining this NPL below 5%. We are always focused on improving our processes, improving the diversity of our loan book. We know we're not perfect and we will never be perfect, but we are always working to ensure that our processes benefit our customers while protecting the company. And we want to ensure that we give the most tailored and unique customer experience to everyone that comes through the doors at Ultra. So the only way to achieve this is to build a team that is driven and is really customer centric. So we had gotten our team up to about 8 members, but we are really focused on efficiency, cutting costs, as well as managing our expenses as closely as possible and as wisely as possible. So our team has now cut down to 6 team members, and we are in a pretty good place where we see that we'll be able to make a really big push to continue to achieve the goals that we have to achieve. So stay tuned. Ultra has a lot coming, and we always look forward to your questions and staying as transparent as possible to the public. So I will pause now and hand over to no stranger, Trevine McKenzie, our Group CFO, to run us through the numbers.
Thanks, David. Good morning to our viewers. Thank you for taking the time to just have a look at what we've been up to for the past quarter, and just so we can answer some questions that I know you have as to what's happening, the way forward, and just to have a conversation about what's going on at Dolla. So just a quick overview of the highlights. We won't spend a lot of time here. We saw growth in many areas. As usual, income growing by 38% year over year. Net interest income growing by 32%, or loan portfolio as usual growing double digits by 51%. And then we had some movements, of course, in operating expenses, which have been increasing over the past quarters, but we saw an increase of 86% year over year, which we will speak about. Cash, of course, increasing as well. And then we have the big kicker here that we will discuss as well. The profit before tax, which reduced by 21% year over year, down to 121 million. So again, year-to-date profits stood at $121 million, and we'll talk about this in detail later on. Kenroy and David both gave us the rundown of our ECL and NPL. Our ECL stood at 3.1%, which we believe is still a good result, even though it increased slightly quarter over quarter. Or non-performing loans, which has been a big conversation, is now at 11.5%. It's above our 10% that we are accustomed to and that we were hoping to achieve. But we do see fluctuations in this number from time to time. And it's still sub 15, which is still better than other market players. So we'll be working to get this down in the next quarters, but still not a bad result for the quarter. And of course, our efficiency ratio at 56%, which increased quarter over quarter. And we're seeing this, of course, because of the write-off that we had to do in Q1. This really increased our expenses, and that would have led to the increase in the efficiency ratio, which we will also speak about in the coming slides. So in terms of where we were on the balance sheets, I did mention that we saw increases in cash and cash equivalents. We moved from $135 million in March 2024 up to $142 million in March 2025, which is just about a 45% increase year over year. We have been speaking about cash over the past few quarters, and we have been advising that we are working to end our quarters with a stronger cash position, and we have delivered on this. For the past year, we have been seeing the company ending with cash above 100 million, and we're really happy about that. And that's something that we will continue to do over the next few quarters, the next few years, just to ensure that we have a strong cash position at the end of each reporting period. The loan portfolio also increased by 51%, and this is due to the $1.6 billion bond raise that we would have executed in Q4 of 2024. All of those funds were deployed and it went directly into the loan portfolio, and we are seeing the consequence of that being a beautiful increase in the loan portfolio, and we will see how this transcended into the income statement shortly. Loans payable also increased by 60%, of course, due to the $1.6 billion bond. No surprise there, but we are seeing where we are making very good returns on these funds that were deployed, and we'll also speak about that later on. And then everything else is, normal, usual changes. Retained earnings as well increasing by 34%, solely because of the increase in comprehensive income throughout the period. Now, if we take a look at the comprehensive income statement or P&L, we would have seen increases in our EBITDA by 25%, moving from $224 million in March of 2024 up to $281 million in March of 2025. Now, outside of this, if we take a look at our profit before tax, of course, we would have seen a decrease year over year, moving from 152 in March 2024 to 121 in March of 2025. Now, if we take a look at what got us here, the first thing would have been on the income statement, which increased by 38%, and we're super proud of this result. Late last year in Q4, we would have unlent the most we have ever done in the history of Dolla, being it over $1.1 billion in that specific quarter. And if we look at Q4 2024 up to Q1 of 2025, we would have done over $1.6 billion. And we're seeing where this has really pushed our total income up to this $500 million or the 38%. Now, if we move down now to the interest expense, which would have really offset our income, we're seeing an increase of 86%. Now, we would have published our results, and there was a write-up which explained the reason for this large increase. And of course, it was due to a small fraction of loans that we had to do a write-off on based on the accounting principles that surrounded the events of that loan. So the collateral that we had on hand, we did our reviews. We saw that it was impaired and we would have accounted for it properly. But of course, this is a one-off event. We don't expect this event to occur in the future quarters. Of course, that's not our expectation. But this write-off is one-off. We expect operating expenses to somewhat normalize, with the exception of general cost increases that the business will, of course, see due to inflation, due to the size of the business, which is growing. We'll continue to see some increases here, but not to this magnitude. Outside of the write-off, though, we did have increases on our marketing expense line. You would have seen the video that was played before, where we had a very large handover of a motor car to a winner of the One on Ready 2 and Drive promotion, which we were really excited about, and we were really happy to be able to give back something tangible of that magnitude to one of our customers who has been with us for some time. So a handover like that also would have increased our expenses, and we did see small increases in staff costs as well, not necessarily due to increasing costs due to operational things here and there. It's just a matter of Ultra is growing, the company is growing, and we do need to ensure that the current staff we have are supported, that we have the capacity to do the things that we need to do, and that we are really running an efficient vehicle here just to get this income to where it needs to be. So we have been operating efficiently nonetheless. Efficiency went up to 56%, but we do expect it to normalize in the coming quarters. And then all in all, on the income statement, we did see the PBT increased to decreased to $121 million as at the end of the quarter. But the good thing here about this is that the one-off event would have led to this decrease. However, for the past few quarters, if we have been tracking what's happening with dollar, we are seeing increases quarter over quarter in terms of PBT. So we would have moved from less than 100 million in Q3 of 2024. We did $115 million in Q4 of 2024, and now we're at 120 in Q1 of 2025. And I think that is really what we need to focus on, the growth that we're seeing over time versus the year-on-year growth or the year-on-year decrease due to a one-off event. So next quarter, we are expecting profits to normalize. We're expecting to see more growth. So just stay tuned, and you'll see that happening for sure. Now, if we move on to our cash position, we would have, of course, ended the period with a stronger cash position than we did last year, March. Of course, we would have utilized some amount of cash like we did last year. And we would have seen movements in cash in investing activities, just a small investment that we have, nothing too major here. And of course, the movement in cash in financing activities was also not significant. And at this time, I would like to hand back to our group CEO or leader here at Dolla to take us through what we will be looking forward to in the coming quarters.
Thanks much, Trevine, for taking us through those numbers in detail and providing our shareholders with some insight into what's really driving, just putting context to the results that we publish. So obviously, the main fact that we published our Q1 results were below what we would have expected. The projections for Q1 initially would have been that we'd have published results that we outperformed what we did a year ago. However, at this point in time, the focus for us is really on looking ahead. How do we make Q2, Q3, and Q4 of 2025 outpace what we did in 2024? And there are a few things that we'll be looking at as we continue to streamline operations and just ensuring that the expectation, what you as shareholders expect from the company, we go above and beyond to deliver those results. So we'll primarily be focusing on expanding our loan portfolio through Q2. We're maybe just days away from launching an update to one of our products. We have modified the product to some extent and partnered with a few players to just make that product more attractive and add more value to our customers. So we'll be launching a product and putting some emphasis on that in a few days or maybe about a week from now. We'll continue to look at the product enhancement and just how we can target more micro and small, medium-sized enterprise with and just ensuring that our process is streamlined and our turnaround is as fast and efficient as possible. The main focus for us for the remainder of this year will be on maximizing profitability, whether that is through leaner operation and just being more efficient in terms of how we view collections and the tasks that we undertake to collect the funds that we lend out. We will, of course, be looking at ways that we can refine. We have started to, it's something that we do on a continuous basis, but we are refining our credit scoring and just our underwriting models, just finding ways that we can use automation to improve speed and efficiency in our operations. And most importantly, we continue to focus on employee empowerment, and just looking at different ways that we incentivize them, and just investing in the leadership team that we have at Dolla to ensure that we move from a level of move from the results that we published in this quarter to one in Q2 that shows significant growth quarter over quarter. The good thing is that despite for the last 3 quarters, from Q3, Q4 of 2024 and Q1, despite the decline year over year in income, we have seen where PBT has been trending upwards, and we do anticipate that we will see some normalization of the profits for Q2, and we work on even improving those numbers as we go throughout the rest of this year. So we just remain very optimistic. We do remain very, very optimistic for the remainder of the year, and I just want to thank you for the trust. Thank you for the support, and I now welcome I'll hand back over to Renee, who will take us through the question and answer session. And I do welcome any questions or comments that you may share as our shareholders.
All right. Thank you so much, Kenroy and team. It is always a pleasure to sit in and be backstage and on screen with you all and hear just the passion, the commitment from the Dolla team as it pertains to the company, the growth of the company, and the future of the company. So we do have a number of questions lined up. They've been rolling in, so we're going to get through them. We have time, and we will get through the questions. So the first one is from Omar, and he's asking if there are any details on that big write-off and what can be done in the future to avoid that big of a write-off.
So I'll take that one. Trevine would have mentioned earlier that our ECL is really done by an external partner, independent external partner, and we do the modules that are used are the factors that are considered in the ECL calculations. Those are reviewed to ensure that they are aligned with market reality, looking at the assets themselves. And we did realize that there was an asset that we held which we thought was impaired, and the most prudent thing to do was to write off that debt. Obviously, even though it appears in our expense or the increased provisioning, it doesn't mean that this is not a matter that we're pursuing, and we will continue to work really hard to recover as much as we can from those scenarios. And of course, once we do any kind of recovery, that is something that will be added back to the bottom line. In the second part of the question, which asks about what we can do in the future to avoid, of course, that is one of the things that I mentioned earlier, just about refining the credit scoring and the underwriting modules that we use to ensure that factors such as these are captured going forward, and we can reduce as much as possible, because it's a business that involves some amount of risk, but we can reduce as much as possible the level of exposure like these going forward.
Great, thank you for that. Jermaine is asking, with rising admin expenses, do you consider leveraging technology for expediting the loan process for your clients? You did speak to this, Kenroy, in your presentation about the middle processes and just knowing that it's not going to happen overnight. And right. I do recall that we have been talking about this for a little while now, about the automation, the internal automation. Is there any update that you can provide on that for your shareholders?
So we have been, to be quite frank, this is perhaps one of the most. It has been challenging, and not just for Dolla, for a lot of companies in the microspace, and one has to do with the cost involved, and of course, two, the time that it takes to build out a proper system that is it's audit tested and proven. You know that all of those things takes time. We're a public company that's audited by a Big Four company. So when we do implement a system, it has to be one that can withstand the test of audits. We have been working with different companies. We have, to some extent, gotten to a point where we even have a part of the automation that relates to the internal loan workflow, where we have built out some middleware and have that in a sandbox that we're testing to see if it's something that can be implemented. But again, this is not something that we can simply just click a button and we implement and move forward. It requires a lot of testing and a lot of effort and a lot of time to get done. So that's really the update where that is concerned. It's something that we continue to work on, and we're committed to fixing this internally so that from the user end, we can also make operations more efficient.
Yes, and to add to that too, this business is a common sense business. So even if you do the technological advancements, you implement AI, there are certain things that technology and AI won't be able to pick up. So, you might have a great credit report and you still aren't able to repay the loan, or you might have a great credit report and your collateral is not in a state where the AI would pick it up. Oh, this collateral doesn't make any sense to accept. The AI won't go look at the property. AI won't go to inspect the motor vehicle. So there are some things that you still need human intervention to be able to make a prudent decision. So we always have to keep that in the back of our minds as well.
Thank you for the context. I'll just jump right into the next question. Simon is asking, what is driving the increase in NPL over time? If NPL is growing, how is credit quality stable? And I believe he was referring, or he asked this question during your presentation, Kenroy, when you had mentioned that the credit quality remains stable, though the NPL is increasing.
So the test of our credit quality, there are two key metrics that we use. The ECL, which of course is extremely low relative to, even when we probably, I believe right now when it comes to ECL, we probably can compare ourselves with some commercial banks, because I know there are no other players in the microfinance space that has an ECL at 3%. And of course, we do look at the NPL that has ticked up somewhat, maybe about 2% over where it was a quarter ago. However, the outlook remains stable, and this is really in light of the fact that our loan portfolio is 86% or 87% secured, and the collateral that we have on hand and just how we do our adjudication, we have a good asset coverage ratio in terms of the loans that we have on the portfolio. So we do expect that there will be fluctuations, especially in events where we have a larger facility where the client is unable to repay like a principal balance of a $50 million loan, and we need to liquidate the asset. The quality of that loan, while it would have fallen into a non-performing state, it doesn't mean that we are unable to recover, because based on the asset coverage ratio, the loan to value most times is like 50% of the value of the asset. And as such, it's really about the time that it takes to sell the collateral. And the reason why we do indicate that the portfolio is still stable, because this is a loan that we will be able to recover, albeit it might take a little bit more than 3 or 6 months to liquidate the asset.
Thank you. Jermaine is asking, how do you balance the desire for a low NPL and taking more risk to grow the loan book?
So one of the things that we're looking at right now is, and I believe David spoke to this too in his segment, is a little more diversification. So focusing more on reducing the average ticket size of the loans that we have on the book. I believe that's a good way to manage both the risk and the growth in the portfolio. And we do see where, again, if we have an event where 1 or 2 loans go in a non-performing state, then the impact will be lessened on the NPL for the group.
Okay, and as you speak about the 1 or 2 loans, it goes right into Simon's question, which is asking you to define few loans, what percentage of the portfolio. And again, this was during your presentation, Kenroy, when you had mentioned that a few were non-performing, and that contributed to the increased NPL.
So the NPL provision or the 11% speaks to itself. I mean, that's a percentage of the loan portfolio that would be in a non-performing state. But if you're talking about the movement from the last quarter where we would have maintained an NPL of about 9%, then it would have been about a 2%. So we're looking at maybe two or three significant accounts that would have made up that 2% movement in terms of the NPL.
And just to add some context to that, in terms of Simon may be speaking about the write-off. I'm not sure.
Yes.
But in terms of the write-off, it would be just about 1% or less of the loan portfolio that we would have written off. So a small fraction would be maybe a better word than few. A small fraction of the loan portfolio was impacted. And we find that 1% is very immaterial, which is the big picture.
And if I can jump in just to kind of close out, Ultra is now about 2.5 years into our conducting of business. And a number of our customers would have come in and taken loans for 12 to 24 months. So we are now getting to that point where, as Kenroy had mentioned earlier, principals are now due. So whereas they may have been able to manage interest payments on a bullet loan, it's now time for principal to be due. So therefore, it will fluctuate once, the principal is now due and we may have to liquidate. So these things will all play a part in our NPL fluctuation. And by we say a few loans, I mean, an Ultra loan can be $100 million. It could be $80 million. And when an $80 million loan goes into a non-performing state and we have to liquidate on a large property, it does take some time and it will cause these fluctuations.
Thank you for that, team. I love the teamwork. Everyone contributed to that one. But while you're on the floor, David, we'll have this follow-up question from Simon. How do you use real estate as security? Does the owner need to own it outright, or do you consider second or third liens?
Ideally, we would much prefer the customer own the property outright. There are occasions where we have managed to consider being a second lien, but I mean, as we've noticed on this call, NPL is very important to us. It's very important to the public. Our NPL will take a beating if we consider second and third liens, because if the person who has the first lien, they're being paid off, they don't have any interest in selling that property, we would never be able to recover. It would have to get to a point where they are not collecting on the first lien, and therefore you're saying, fine, we're going to liquidate, and therefore the trickle-down effect will happen for second and third lien holders. So ideally, we'd like to be the first and only lien on the property so that we do control when we can liquidate as we deem necessary to manage our affairs.
Yep. All right. Thank you. I'm jumping now to a quick one from Simon. He's asking, has the efficiency ratio been increasing or falling? He remembers it being higher a while back.
For the efficiency ratio for the past 2 years, it has been pretty stable below 50%. So we've had it at about 46%, 48%, 50%, but it has increased this quarter, and it's because of the write-off, which I think I did mention earlier. So it has been stable for the past few quarters or the past 2 years, but we had this one upsurge to 56% in this quarter, which we expect to normalize.
Thank you. And Jermaine is asking, has Dollar considered foregoing dividends to retain capital to unlend? How do you balance both priorities?
So we would have made a publication on the JSE maybe a week ago to say that, the board will be considering a dividend payment. It's a little too soon to answer this question. We'll allow the publication to be made for the results before we can even speak about that. We don't want to get into trouble with the JSE and the FSC, and yeah.
Certainly. And I do think someone else had asked a similar question about that consideration to forego dividends. So that response will cover both. Thank you. Simon again, Can you also show the credit health metrics of the Ultra portfolio, please, given that the issue seems to originate in Ultra?
Before, I think maybe Kenra or David would be good for this question, but the issue didn't necessarily originate in Ultra. I believe we can safely say it's about maybe about a 80, 20, 70, 30 kind of ratio between the effects from Ultra and from Dollar. But I'll allow Kenroy and David to give more insights into that.
Yeah, I think that answers. I believe when we can commit to, of course, providing or sharing a little bit more insight on the future earnings call, about what specific metrics you'd want to see for the ultra loan portfolio. But Trevine would have answered that in terms of the impact on the overall numbers for Q1.
So I think to give a little more context around that, what David asked, can you start producing a segment comparison in the quarterly report and what was Ultra's performance in Q1? I think that gives a little more context as well as to what your shareholders are looking to see. I don't know if there is anything else to say apart from what you've already said on that part.
Right. That I guess we'll discuss and get back to you on for sure.
All right. Thank you. This one is for you, David. What are the key roles within the Ultra team right now, and how will that change in a year?
Okay, so our team is at 6 members right now. Myself as CEO, and I therefore wear all hats. We have a credit risk adjudicator, sales, marketing, collections, and a loan admin. So these are the key functions of, I think, any loans company. So these are obviously our main focal points. We have 1 member currently in each role. So I think the only thing that could possibly change in the coming year or in a year's time would be maybe increasing the number in certain roles as we see fit. Currently, based on our portfolio at 65 active loans, we only need 1 collections person because that should be enough for 1 person to manage. If we get to a point where we are at 120, 130 active loans, then yes, we may need to increase our collections team. Once we have, I think, normalized our processes are right where we want them to be, or are in a very comfortable state where we're looking to push heavy growth, we have the capital to do so, then yes, we may look to grow our sales team and such. We're also at the point where the number of loans that we do get on a daily or weekly basis, our credit team can manage that traffic. So at this point, I think we're at a very comfortable and efficient point. But obviously, as we grow, I think we just may need to increase the numbers in those specific roles where we see fit.
Thank you for that, David. And David Rose is asking, were most of the defaults or bad debts attributed to Ultra or to Dollar?
I think Trevine had actually just touched on that point where she had said it was about a 70-30 split. But again, I think what we just do need to take into consideration are the size of Ultra loans versus the size of Dollar loans. I mean, a single Ultra loan could account for 100 different Dollar loans. So I think that is to definitely be taken into consideration. But as Trev mentioned, it was about a 70-30 split. And the 70 would be on Ultra side based on the significant size of our loans. But as the team has mentioned, these are not in a completely irrecoverable state. We are pushing to still recover as much as possible. And once we do so, that will hit the bottom line going forward. But we had to be prudent and we had to be as transparent as possible and make the provision. And we chose to make the provision all at once.
All right. Thank you for that, David. No, this is just an acknowledgement of Omar's question. This was also about retaining cash through, non-payment of dividends. So Omar, just to reiterate what Trevine had said, we'll wait on the announcement, right? Mm-hmm. Now, David's next question, David Rose, says, Dollars NPL ratio was 6.5 in December 2022. It's now 11.5. He has two, but it's 5 in Q1 2025. This is against the backdrop of a larger loan book. Is Dollar now being more prudent with lending in the slow economy?
All right, so I'll take that one. I believe, thanks for the question, David. And in terms of context and just appreciation for the numbers, in 2022, I believe Dollar's loan portfolio was about $750 million. It's now at $4.3 billion. And some of the key differences between the two periods is that at $750 million, our average loan, our average ticket size was somewhere about 400,000. And at 4.3, our average ticket size is in line with about a $2.5 million per client. Additionally, in 2022, we would have had a scenario where the loan book was mostly secured by motor vehicles. In 2024 or 2025, a significant chunk of the loan portfolio is property secured. So the liquidation and the time to sell would have been materially different. When it takes 2 weeks to a month to sell a motor vehicle, it takes 6 months to a year to sell a property. So that's one of the key differences in the period and what would have driven the increase over time. But again, the mere fact that the portfolio is so heavily secured, we know that over time, this will level out and we'll see a reduction. In terms of the second part of your question, David, about the change in the model and accounting for, a slowdown in the economy. I'd have alluded to this earlier that we continue to refine the credit models. Some of the changes in the economy too would have affected a number of. We've seen where there is a slight slowdown in terms of the ability to repay, especially the significant balances, and that's where we're now in a position where we are liquidating a few properties to recover interest. But at the same time, one of the things that we're looking at is really to diversify somewhat the collateral. Even David spoke about this earlier, about moving, having a mix of motor vehicles and properties, and just looking at the properties that we accept to ensure that these are properties that we can still be able to easily liquidate. And we're also looking at just reducing the average ticket size. And I believe that these factors together should assist us in the medium to long term in terms of maintaining a quality loan portfolio.
Fantastic. And as a follow-up to that one, David is also asking, or he said, you mentioned the credit model. Is it that you're modifying your risk parameters to better reflect market risk?
And that answers the question. I think I answered that question just now. So that's correct.
Right. Fantastic. So now we're jumping into the JSE rulebook changes. We have a few questions, comments about that. So the rulebook should be amended soon to account for the 750 million share capital threshold. Is Dollar looking to still list Ultra, and is the listing timeline contingent on the rulebook change?
That is a discussion that continues. We really can't provide much more detail right now than the fact that we're guided by the board and by our financial advisors. We continue to be in conversations with them about any kind of future fundraise, whether it's bond or equity, and that's just what we're guided by at this point in time, the board and our financial advisors, and we continue to have those discussions. So as soon as we're able to provide more concrete details, then we'll definitely get into that.
And Jerome says, along the same line, if the new junior market limits don't apply to already listed companies, would that speed up the pace at which Ultra is listed in order to access cheaper capital?
This is so interesting, these questions, because guys, you know that we can't come on the platform and say, hey, we're listing Ultra. No. I believe, don't quote me though, the increase did take place as far as I am aware, but we are not looking to do this in the next few quarters. That's the most we can say for right now. There's a lot to take into consideration, including the dilution of, the dollar shares, there is what's going on right now in terms of the stock market, the economy, all of those things we have to take into account. And as Kenroy mentioned, we are guided by the experts or financial advisors or board of directors and, all our other advisors who are, just keeping us on the page of, making the best decision for the business at this point in time.
Absolutely. And I think this is the final one on this topic. And this is a comment, not a question. One Cocoa Investor says, I think Ultra should remain a sub of dollar for now, at least. Concentrate on growing the business. Junior markets are too small. Everything is going to cents. All right. So thank you for that, One Cocoa. Now, Jani asks, given the current economic climate and the company's performance in Q1, what is the outlook for the rest of the fiscal year? I believe you would have touched on this. Well, both Kenroy and everybody did. But is there a summary that you'd like to give on that right now?
I think we are just looking to outpace what we did in Q1. Improvement is always the goal. Returning value to shareholders always the goal. So that's really what we're looking to achieve.
All right. And same viewer asks, what makes Dolla Financial a long-term bet in Jamaica's and the Caribbean's financial future?
So I think what's that? Oh, Jenny. Jenny, I think Dolla continues to grow. We've been we've gotten to the point where we're a household name, and a lot of individuals, both the underserved and even some who traditionally would not be looking to microfinance for help. I believe this is one of the few microfinance companies that have focused so heavily on growing small businesses. That's really, I believe, one of our sustainable competitive advantage that we have. The fact that 90% of the business that we do lend are focused on taking a micro business to a medium business. And we continue to see where we even assist customers who they're at a stage where they're not yet able to access credit in the traditional sector, and we have seen where we have even been graduating some of our customers where we can no longer do loans for them because they've now grown to a level where microcredit is no longer applies to their need. And that's one of the main difference with Dolla, which I believe is an indication of just how viable we are as a company and just how much potential we have to grow, not just in Jamaica, but as you said, in the Caribbean.
And congratulations to you and your clients who would have been able to make that step up. It's not an easy thing to graduate in that way. So to move from micro to medium or micro to small, it's a big deal. So congrats on that. And the final question I'm seeing in the chat, I do have a couple others, but this is the final one I'm seeing in the chat right now. It's from One Cocoa. And I don't know if it's really a question per se, but One Cocoa says, can dividends just be paid from retained earnings and not fluctuate so much based on profits for the quarter, so investors don't think that Dolla is doing poorly and need to reduce dividends?
I mean, I would say dividends are technically paid from retained earnings. The way it's accounted for, it's actually reduced from retained earnings. But we are guided by the dividend policy, which is in place, and it makes a determination that it's paid based on or declared based on how profitable the company has been doing. So that's the way it's calculated based on the dividend policy, and we are currently guided by that. And I mean, you wouldn't want to see the company, declaring profits of $100 million in Q1 and paying out dividends of $100 or $200 million, even if it's sitting in retained earnings. You want to see a matching kind of taking place where, we're making profits and we're paying dividends based on that. So that's a part of the reason why the dividend policy is also crafted that way, just to ensure that there's a little matching happening where that is concerned.
Yeah. So I think that question came in response to the suggestions that dividends be withheld uh, to, give the company more cash to unlend. So thank you guys for those responses. We have been talking about the strategy and the outlook and the numbers and everything. And I have a lighter question for you now, right? Before I go to a not so light one, but my lighter question for you now. We spoke about the CSR and what Dollar does for the community, what you do to help others and to continue showing your corporate social responsibility in the space. Can you share with us a little bit just the impact of some of those activities, like sending those students to the JC conference? What was that impact like for them? We saw the video for the one and ready. How do these things uh, make a difference in the lives of those you are reaching out to?
I mean, Kenroy, I think Kenroy is going to add so much flavor to this question, but we are dollar customers, we are ultra customers, and if it were us, receiving all of these, the benefits that the company is seeing from, listing on the stock exchange and making these profits and online to customers, we would feel so wholesome within ourselves to be able to, receive that give back. As a company, we are always so happy to give back. It's not just about making profits. It's not just about returning value to our shareholders. It's returning value to those customers that we have, that even aren't shareholder community, that help to keep us safe. They help to, promote. They just, just give assistance where it is needed. So it's one of the best things that we do. I remember when Kenra went to the Bustamante Hospital, he was so excited. It makes the job feel so much better. But Kenra, you can add your color.
No, that's fine, Shereen. That really addresses a lot of times we do everything for to ensure that we return as much value as possible to our shareholders. But I can tell you that having the impact, it's really about making an impact on the lives of others, and I do believe that contributes to why we're such a successful company at this stage, without any doubt.
Absolutely. I do think that giving back makes a difference, not just for those who are receiving, but also for those who are giving, because it makes your team see more of the impact of the work that they're doing every day. So it helps the team on the ground, it helps the management to, and it helps everybody to kind of de-stress a little bit and not just be so focused on being locked up in the office, but being able to interact with those around them. So congratulations on that. I think it is significant what you're doing and what you continue to do in that arena. So keep up the good work there. And two other questions. Kenroy, you had mentioned in your outlook about the credit score and assessing credit scores, etc. Does Dollar currently contribute to the credit bureau? I'm aware that there are some entities who are able to pull from, but not necessarily contribute. But do you contribute to the bureau now?
I don't want to. I don't know if I should answer that question, but we at the moment we are connected to the credit bureau for many things, whether verification of identification and just extracting details on while we assess credit. At this point in time, we haven't been submitting data to the bureau, but it's something that we are working on. Again, this is one of the areas that I believe would have been in place already, but it requires some amount of technical work, and we are in the process of getting that done. I do believe that it's a key partnership with the credit bureau that can strengthen our collections and just business in general. So that's something that we're focused on at this point in time.
Absolutely. Thank you for that. And finally, as we close, we would love to hear your thoughts on the current performance of Dollar on the stock market as of the time of this call, the stock price was at $2.24. What are your thoughts around that, and what do you have to say to your shareholders around your share price?
So certainly that's public information, and even if it, we come on this call and we share and give insight in so many different parts of the company or different aspects of our operations. We acknowledge the decline, obviously, in the share price, and we definitely understand any concern that this may raise from a shareholder's perspective. I know that the market sentiment has really been affected by broader economic headwinds and so many other fundamental things that are not related to the business itself. But I do believe that with strong growth in our loan portfolio, strong growth in our top line, which would be the revenue, the shareholders are really, or the market is really looking for improved performance from Dolla. And looking ahead, we on this call, our team is really focused on driving profits over the next 3 quarters, expanding the loan portfolio, improving our credit and our collections, and just managing the cost that we do. And I do believe that once we continue to produce some solid results, that we will see some impact in the share price. It's not something that we have control over. We really can't control what the share price is. What we do have control over is our performance, and I do know that the market loves to see growth, and that's what we're focused on driving over the next several quarters.
And just to add to that, investing is for the long haul. So think about that. Think about the growth that the company will experience over the next few years, and just think about how holding that stock will benefit you in the long haul. Think Warren Buffett.
Yes.
When you're thinking about investing in stocks. So that's also my 2 cents.
All right. So with that, I want to thank you all again. Thank you to the Dolla team for being here with us today. Thank you for taking the time to speak with your shareholders, to share what has happened in Q1, what you're looking forward to for the rest of the fiscal year. We continue to be excited for the future of Dolla, and we look forward to continued earnings calls with you to hear more about the progress and the growth, the performance over time. So thank you again, Dolla team.
All right. Thank you very much, Renee, for facilitating this call, and we look forward to improved results and an even easier, I guess improved results for Q2 and beyond, for sure.
All right. And thank you again to you, our audience, and the shareholders of Dolla for tuning in, and we will see you on the next call.